Look, I got Lexi, Libby. So I've got two dogs with L's, and I call Libby Lexi and Lexi Libby. So it's, you know.
Well, I call my cat Louie, so make sure that I don't mix up. I can call my cat Louie and call you like my cat, and it's all the same. So.
Oh, it makes life easy. Yeah,
Yeah.
I should have just named my dog JP. Although she's a female, so that might give her a complex.
Yeah. So good morning, Louis.
Good morning, JP. Hey, today we're going to talk about emerging themes in the markets, and we could take it to wherever you feel like we need to take it. You know, yesterday we had a conversation on the phone, and we were just discussing some of these themes. So I thought maybe we'd just talk about them. And actually, you thought we should talk about them. So maybe I should let you start. What are the biggest themes you're seeing right now, and maybe some examples?
I brought a prop today, so that's a rope here, right? So what that is a representation of is my feeling about the market. Is there is a tug of war right now going on in the market. I think you are seeing an interesting balance of people that are definitely looking at the what I would call pro-cyclical, looking at this recovery, the post-COVID and the recovery, definitely playing out with some themes that we can discuss what we're seeing, versus definitely the more conservative approach to portfolio. And we're seeing that play out in the market on a daily basis. You're seeing now a much more active balance between buyers and sellers, as well as what we talked about, leadership, right? What's leading the market on a daily basis will vary depending on the way the wind blows, the way the news are. And I think that's probably the main theme that we are seeing in the market. And maybe I'll just ask you, do you at least agree with maybe that setup, that it's what the market is at a bit of a inflection point, if you will?
Absolutely. And in fact, that's exactly part of what I'm going to be talking about. I'm going on the final bar with the stockcharts.com later today. And my first point is that same point, that we're in, I actually say there's more like two regimes. There's one regime that is looking primarily for growth that's going to happen regardless of what happens with the pandemic situation. And you can see that by what the market is rewarding. The market is rewarding companies that not only have historical growth, but more importantly, that there's expectation of growth right now. And they also have great capital efficiency, strong margins, strong cash flow. And so the market is looking at that, but they're also they're starting to sell some of those securities that have gone up. And we can get into some of the details later. If you look at some of these individual names, some of them are having healthy corrections and others are not having healthy corrections. So I think you have to differentiate between the two. And then, but the other side of that equation, the other side of that regime is like you called it, pro-cyclical, and I agree with that description of it. It's really more like, okay, if this is a recovery and this has got legs, what kind of companies are that need to move higher? And there's some that are moving higher regardless. And that like for example, everything related to do-it-yourself, DIY stuff like the Lowe's of the world, Masco, Sherwin-Williams. And then there's also the home builders, everything related to the home builders. Now we've got a lot of the demographics are moving in a direction where irregardless of what happens here, we've got a lot of millennials that are moving into houses. And you have a lot of people who are in the older generation also, moving out, changing houses too. There's a huge amount of demand shifts that's happening as people are moving away from the inner cities and they're moving to other states that have lower taxes and better standards of living, and people want to get away. So there's a huge shift that's happening there, and that's I think going to happen regardless, and we can get into some names there. But really, I think you're right. We have this tug of war here, and some of the companies that are selling off probably should be sold completely, and others probably are going to set up buying opportunities.
Yeah, and I think that's what we're seeing. I mean, we've been selling some things that you said, like some healthy correction that you're like, okay, I love this company for the long run. This is perfectly okay. And others, you're like, okay, now it's time to get out. As some things were, as we discussed before, a little frothy on the valuation, and always go back to, what are the fundamentals driving, those businesses, or is it just market sentiment? And those things, that's your highlights. So I'm having too much fun with the data right now. So as you know, we look at things, as we've discussed in the past, we have different characteristics that we look for in companies. We look at things from a just broad stroke quality, so the quality of the business. And here we're talking about quality of earnings, balance sheet, these kind of things. We always look for strong quality. Then we look at, of course, what is the value, but we look at value more from a how much are we paying for the growth that is in that business, right? So just looking at the current valuation. And then we look at technicals. We've talked about in the past couple of weeks, some of the factors we look on the technical side, which gives us a sense for, is the market rewarding those companies, right? So looking at our data, at our proprietary model on a very broad universe, I started slicing and dicing the data by industry and by size and see, okay, what's going on right now? And right now we're still leading, I would say, like large cap. The main theme that's still in place and seems to be healthy still is the large cap, high quality stuff is still really in charge right now and driving. You're seeing that show up into the numbers, and you're seeing some of the leading sub-industry right now. Gold, I mean, I think we can, you probably have some thoughts on it. I'll probe you later, but talk about maybe there is a weakness in the US dollars. There's some maybe fear of inflation. Those things are driving those commodities, and those companies are definitely looking superb, like the Newmont of the world. But then you have emerging themes that are things that, again, play into that more forward-looking cyclical. Residential construction comes in, right? You have, and then just not too far down the road, you have building products and equipment. So all of these things that are really related to either people fixing their homes, getting into new homes, moving around, like you said, all of these show up in that list. But then you're seeing things that are more like industrial, like we follow the economic chain, right? So the basic materials right now, we cannot love them anymore. Like there's some great things, besides gold, which is maybe driven by the commodity itself. There's some other basic material products that are more key to our industrial complex. So you're talking about copper that has a huge run. You're talking about, like you said, basic chemicals. Those things definitely are an indication that there is a demand for these products, and we're seeing that in some of the industrial that are showing up. Something that I think we agree on that theme, trucking and freight is, I'm seeing those sub-industries showing up great, both in the large cap area, but also in the small cap. So, all of that, kind of moving of goods. I mean, I was reading yesterday some research from McKinsey that we have gone 5 years in 3 months with respect to e-commerce. Like if we had kept the trend that we had prior to COVID, it would have taken us 5 years to achieve the level of e-commerce that we're seeing today. So you're seeing things like industrial REITs, basically the people owning those warehouses, love it, right? We own Prologis, love it. And then those are showing up well, supporting that great growth. So those themes are there, and they probably have some legs to go. And then of course, some other areas of healthcare, seeing like healthcare throughout the entire spectrum, in various areas, from of course a more biotech, which is probably driven by what's going on with COVID, but more also into the healthcare providers that right now may be driven by what's going on the political scene, and now I believe we're going to start seeing a little more of those themes being driven by what's going on with the polls and what the chances of who's going to be in office. So I think we're going to see an increased amount of focus on that.
Yeah, we agree on that. And we kind of had a good long discussion about that. There's a lot going on with the election, that there's already, those trends have already started, and some are extended actually, like and probably going to pause. But what's interesting, just going from experience, a lot of times these things, they'll have an anticipation move. It could be a big one. They'll pause for a while. But if what is expected actually happens, then you could have a continuation that's very large. So for example, in the solar area, you could have very large moves. In the cannabis area, you could have very large moves if we have a blue wave. So that's I think there's a lot of people that are anticipating that. There's a lot of hope on that for investors that are invested in that area. I think if that gets dashed in any way, we'll probably have some very large pothole moves, like air pockets, like the things will just fall off the cliff, right? So you have to be careful with those. I mean, I was looking at the sizing on Solar Edge, which is one of the holdings that our proprietary account has. And that one, you know, it's sized at like 20% of the average size of our other holdings just because of the volatility problem. It's a big volatility. And what's interesting is that the data shows that high beta, high volatility stocks generally don't do better than the market as a group. But there are lots of exceptions to that. It's an exception game there. You have to have something that's a continuation, as long as that volatility is to the upside. And I think the reason why some of those volatility factors, by the way, don't show that phenomenon has to do with the fact that if you just look at it statistically, stocks have higher volatility when they're moving down. So it's just kind of a way of showing you, hey, this is moving down. It's an indirect way of trend, actually. It's an indirect trend indicator. But getting back to these themes, you know, you mentioned pretty much most of the themes that I've been seeing too. We've been discussing this. We've put money there already. I mean, what I'm concerned about right now is that, actually, I shouldn't say I'm concerned. What I think is happening right now is a lot of the macro stuff is affecting these more basic industries, and that we can have big moves. So, you know, traditionally when you thought about the macro picture with the Fed, you normally thought about them basically just injecting money and then lending would increase. That would affect businesses. You know, that would be the typical way. But now with this new monetary policy way of kind of backdoor doing fiscal policy, that's really affecting the demand side of the equation. So just to kind of back that up, instead of just putting money to actually lining the pockets of the wealthy, that has been happening for quite some time due to some of the actions by the Fed, because it's been affecting asset prices, not necessarily consumption and incomes. So, but what's happening right now is the Fed is starting to print money, and then that money is basically being converted into demand by the Fed, the fiscal policy being pushed out. So that traditionally that's been calling monetizing the deficit, and you don't hear people talk about that much, but that's basically what it is. You get all these newfangled words like QE and all this other stuff, but what's happening right now is a very, very old-fashioned thing that's been done many, many times. And so normally what will happen, I think because of the stress and the unrest in the economy politically, that will, no matter who's in office, my view is that we're going to have more of that type of government intervention, which is going to create more demand side, which I think is going to help these basic materials, these industrials, and plus the fact that we're going to be bringing more and more business onshore away from offshore because of many different reasons. All of that is going to lead to most likely initially a demand boost, but that one of the challenges is that in order to accomplish these goals, typically what is required is to devalue your currency. So I believe if we continue on this path, we're in a devaluation phase, which is going to help gold. It's going to help the euro, international bonds that are denominated in non-US currencies. However, those other currencies are also, having problems too, because guess what? They're doing similar things too. They're kind of, so Europe is doing similar things. We're getting into, this is really interesting. You know, back when Trump first got elected, we had an employee who was from China, and I told him, I said, I'm telling you that there's going to be more pressure on China, period. And there was. I mean, it happened faster than I thought. Back when I was in grad school and I was talking about the Chinese yuan being pegged, I had students telling me that they disagreed with me, like, oh, you don't know what you're talking about with the Chinese peg and all that stuff that's happening. And so sometimes these things can take decades, right, for it to work itself out. So I think what's happening right now, which is what we care about right now, is that we're going to have a demand increase. And there's going to be a ton of money thrown into the middle class right now. And they're just going to throw the taxes out the window. They're not going to care about the taxes. In fact, they're talking about tax reduction, believe it or not. I mean, so this is not good for our currency. It's good for gold. So for investors that don't own gold, I don't know why an investor would not own some physical hard assets at this time. So I've been talking for a while, so I'll let you talk. But I think a lot of this is really driven by policy. And because normally, think about it this way, we would have had a ton of defaults by now. If you have an 18% unemployment, like we have right now, we would have had a ton of things happening. There would be tons of foreclosures. There would be tons of cars and people turning in their cars. You don't have that. So what's happening right now is not normal, and it is a prop, and it will, right now it's okay. We have, I forget what the number was, but something like 30 million people are living off of the bankroll from the government right now. Big number. We can get into a huge argument as to why that's happening, but and I think we should probably stay away from that conversation because, for investors. But the reality is our job is to make money for our clients, right? And so this demand side thing could get much bigger.
Yeah, I mean, I agree with you, and thanks for maybe looking at it from the more macro perspective. And I think those are macro trend, and you don't want to bet against those. I mean, those give us that tailwind that we need to support our thesis, and then we can go to town, right? Take a top down to some extent to understand these trends. And I think you played it out. And right now, until we have indication of a change in those policies or trends, I think we can take them for granted. What's interesting though is you talked about this demand side, right? So I want to make sure that always, and I'm going to bring it down to company and investment opportunities. You want to make sure that this is not just hot air, right? That's lifting these stocks. You want to make sure that there's real economy and real economic activity supporting these businesses, right? The way they make money. So it is our job to finding that those drivers really are doing that. Whether so gold is one thing, right? But then industrial materials. Is there really demand for it? And there is. And we're seeing semiconductors doing exceedingly well right now. Yeah. Semiconductor equipment, semiconductors. So we know like all of the supply chain. I mean, there are some things that are taking place from a corporate spending, right? So we're like going to 5G. We're doing all sorts of innovative, AI and all of those things have a lot of spending attached to them that is supporting those companies. So this is independent from pretty much, what else is going on. There is money, there's investments in those areas, and you want to be.
That's a huge thing. I'm sorry, just
go ahead.
Tiny slice here. I love the fact that you said that's independent, because I think that's really the play here. We're going to try to find independent opportunities, non-correlated to all this government stuff. And then, but we have to be cognizant of how we're going to play out all the government stuff too. But the independent, to me, the most exciting stuff is the independent opportunities. Anyway, go ahead.
Yeah.
I was just.
No, exactly. And I think that's what we're seeing. Some of it is, of course, the cat's out of the bag, and it's priced in pretty richly by the market. And then so we're looking maybe for the next, always say like that second order maybe impact. So now we're looking, okay, who's the beneficiary of this early recovery, and which one has more sustainable, like as far as whatever little visibility we have into this world right now. What are the things that we can take for granted, and we believe we'll have some persistence going forward, right? Like for example, I reuse that theme, but and I think this one is pretty well known, but the e-commerce thing, right? So this thing is not it is not going anywhere. I think it's only going to increase. Even if we have a vaccine tomorrow and we all go back to normal, I think we're still going to shop online more than ever, and but at an increasing rate with a variety of sources, not just your Amazons of the world. And you talked about names that have been selling. Amazon is still very healthy as a company, but when the market sold off, you're seeing those large names that have a large. We had our session on the index concentration right now. These large index constituents have been selling off on very high volume. So definitely profit taking, definitely investors are taking some money off of those large names and recycling it into hopefully, you know, some of those emerging themes, however people look at it. Now we're seeing for the first time in a while, and that's something I want to make sure we discuss this morning, is we're seeing action in the small cap, right? Which small cap has been neglected and underperforming for so long, we don't even remember what a small cap looks like, right? But then we are seeing right now, so I'm looking at it right now, and on the bottom couple of quintiles by market cap, you have smaller companies. The quality is lower, right? I mean, when you look at the average quality score, it's definitely lower than what you see on the cap. So you have to be careful. That's where security selection really, really plays a much more important role in the small cap. But we are seeing some what we call emerging value, right? That means companies that have you know, their T score, like their technicals are starting to show up. The businesses are exposed into, like, it's pure plays into some areas that we want. So it allows you to be more precise into playing these pockets of recovery. Like I'm looking like recreational vehicles, which is funny. Like we spend a lot of money on boats and RVs and things like that. So that seems to be like, because we don't travel as much, so we're going to invest into our, you know, fun and our toys. And we're seeing, you know, these names do very well. And as opposed to owning maybe Winnebago, which is a great company and all, there might be some other, you know, pure smaller plays in that. And I think we can.
And they're all over the place.
Yeah,
I mean, they're in the building materials. I mean, they're those small company names. I mean, when we were talking about this yesterday, because I'm putting together these technical groups based on our style, which is not like a style box that you would see in traditional sense, but we have styles that we're looking at, that we're tracking, and I'm putting together some technical indicators for those to track them. And the first thing I noticed is that there was a huge unloved theme with small cap. There's an underloved small cap thing going on that makes no sense from a fundamental perspective. So the quality is there. I mean, yes, overall the quality is lower, but you'll have adequate or good quality companies with amazing valuation, and the technicals are just kind of meandering, starting to come back, but not quite there. Kind of an emerging value style that we have. But I don't think that the institutions have moved that way yet. I think as the equity risk premium further expands, that's when that's going to hit as we pull out of this thing. As we, you know, and really whether or not we pull out, how this thing transpires is going to be big. But it appears to me like we're going to pull out of this thing big, mainly because the government is not going to allow it to. They're just going to keep putting it in. They're just going to keep putting that money in.
Yeah, I mean, I think we're in that cycle right now, and it's a global one, like you said. Like I think the central banks globally are in lockstep right now. It's a race to zero. Nobody can raise rates because they all take care of their own self, right? So you know, there's a lot going on here. It is you know, classic economic theory would tell you that all of that is very inflationary in nature. However, that is a fear right now. It hasn't showed up much of anywhere, even though we're seeing some inflation in raw materials. You know, finally in some.
Well, I agree with you 100%. It has not shown up. If you look at it historically, there's a sequence of events. First, you have a bout of deflation, then you have an over response, and then as that mechanism is turned into the velocity of money, then the inflation hits. So as that velocity of money hits, that's when we're going to see the inflation. So we have some big forces of inflationary forces that are just kind of stabilizing right now. So if we think about what we're saying now, we're saying, oh, there's demand side and it's going to be basic materials and all that stuff. Well, that's basically saying that's going to be inflation, right? So first there's an increase in demand. The prices haven't moved up yet, but as that demand increases, prices will move up. And so we just don't have. The reason why we haven't had the inflationary set up before is because that we've had inflation in asset prices, not in goods and services and spending. The money that came out before was going into the financial assets, and that's what I mean. That's why one of the main reasons we have this big divergence in the haves and the have-nots has to do with those who own assets were getting injected with money. and those who did not have assets or had little assets were not. And that has not necessarily trickled down into higher wages. So now with this new policy set up, they're basically using monetary policy to indirect backdoor do fiscal policy.
Yeah, exactly, because we're going to run out of tools, and I think everybody is chipping in. A point you made, and I want to bring it back to being the DCF geek that I am, evaluation, inflation. Why do we care about inflation when we're equity holders? Well, inflation is so it translates into the type of companies you're looking for, right? So if you have a fear of inflation, if you think price of raw materials and people goes up, that basically means two things. The companies that are able to pass on these increases, that have pricing power to their markets, are going to be in a better position than the alternative. So companies that do not have any pricing power will see by default their margins and their profitabilities go down.
That's why the market is rewarding high cash flow return on invested capital.
That's correct.
Firms that don't require a lot of capital or labor that are leveraging technology.
Yeah, exactly. We've seen some inflation in labors in high tech specialized areas. In Silicon Valley, we know notoriously it's been tight for talent. We've seen that, but these companies, these pure tech companies, are so profitable. When you bring in 35% of the bottom line, it's you can still take a hit. But if you have a much razor thin margins, a grocery store, for example, that's up 2%. Any margin impact will be felt doubly. So I think while we have had expansion in margins for the past decade during the last cycle, I think now, for example, if you look at this earnings, we're right at the epicenter of earnings season this week, in general, earnings are down about high 40%, 47. But if you look at it, where does it come from? So top line is down on average about 16%. The rest is basically margin contraction, right? So it comes from one or the other, right? The bottom line is revenue minus cost. Last time I checked. So if we know that margins are under pressure right now, and so when you look forward, you certainly want to be cautious as to how can these, of course, high fixed cost companies would be levered up to the economy, but we have to normalize to what I believe is maybe a compression in overall margins going forward, which is going to affect how you discount companies. So I mean, those again go back to fundamental characteristics of firms that you think are going to do well in this environment, considering the
some stocks will do very well and keep up with the purchasing power problem if we do get inflation, and others won't. And so we want to be on the right side of that. But as you were talking, it really reminded me. I actually had a flashback. I had a flashback when I was studying the senior level macroeconomics. It was like a econometric type class, and my professor studied under Milton Friedman. So this guy was like a Milton Friedman guy, right? So I learned a ton from this guy. I wish I remember this professor's name. I should go back and look. Anyhow, what he's talking about right now is the same stuff this is like no different than it's like real basic stuff, right? From somebody who's studying economics. And I think if Milton Friedman were here today, he'd have a few things to say. I'm not saying that I'm a monetarist, but I think, this velocity of money concept is not being fully appreciated. and when it does, and the interesting thing is that when it is appreciated, it actually is like an ignition of a fire. If you go back in history and you look at it, it's not like you have this slow rise of inflation. No, that's not what happens. It goes, oh, no inflation, wait, inflation.
Mm-hmm.
And so that's what's going to happen most likely here. I mean, if history is a precedent, and I could be completely wrong, but that's what I think is going to happen. So I'm ready for that. But if we have the right stocks, and by the way, when that happens, stocks get decimated. So they are actually a inflation hedge long term, but they're not. It's not one-to-one. Not, at least that's not what the technicals show. That's not what the data shows. So it doesn't mean it won't be different this next time. But if if I look at the data, when inflation goes up, stocks don't necessarily go up. It's actually, over time, it works itself out. But during those years, it's very painful for stockholders, or it can be. It has been historically. So I think there's reason to be worried about it, is what I'm saying.
Yeah, exactly. You know, I think those are risks that we need to take into consideration. You know, whether they're not tail risk. I mean, you've got to call them tail risk, if you will, because they're going to probably be priced. And as we know, the market is not gradual in pricing risk. It's just one day it's there, the next day it's not, or vice versa. So we just have to be cognizant and understand our bets, right? I mean, something that, you know, when we look at more aggregate pictures, this is the goal here, is to try to understand what is your exposure, is what we call it in the portfolio, right? To understand, of course, there are sectors and industry bets, there are size bets, there are bets across all sorts of course, geographical bets. And understanding that is extremely important. And I think right now, more than any other time. So you want to construct a portfolio that hopefully takes into consideration your view. Some people don't care about this macro view. Clearly, we talk about this, and we're cognizant about these themes when we construct the portfolio, and may make some intentional bets on one way or the other, right? Whether we want to be pro-cyclical or not, at least we will understand, you know, so that not everything is in there. You mentioned the way we look at maybe technical condition buckets, right? It's telling us that, well, maybe the companies are in different sectors, but somehow they're in the same condition from a market standpoint, and therefore probably would sell off at the same time. Well, that may be a pretty unique way of looking at the world. So, so there's, you know, there's risks that are obvious and some that are more hidden, and our job is to try to control and understand risk, so that we can get the proper size, proper portfolio construction, which is
and really look for where the opportunities are too, like what's, you know, what is really likely to continue to move higher, and really just stay with that and using risk management rules around that. So it's I agree with you 100% on everything you just said. There was something you said in there that got me thinking about, well, one of the projects we're working on right now is creating our style. We have very unique style buckets, but the reason why we use these style buckets is just because we want to understand kind of some of the group workings within the equity market. But if you know, without, and I don't want to get too far out into the macro realm here, but I'm just trying to bring it in because I actually believe that the macro is more important to the stock market now than it has been in a while, because most of the moves that we're seeing is related to that. It hasn't really, since 2008, we haven't seen as much of a need for macro. You know, it's been kind of a non-event because things just kind of brew, and then, but you can't stop these trends, you know, very quickly. And so for that reason, I really think that some of these other names, I don't think the tech stocks are going to be like gone forever. Like people are thinking they're over, they're going to be crashing and all that. I think they're going to be sources of funds, and you'll see some of these stocks sell off more than others. For example, if you look at Microsoft, you know, from a technical perspective, it has had a worse sell-off. There's been more downside volume there than, say, for example, Adobe, some of the big cap names. You know, you look at other types of tech companies are now being more looked at, and there's a broadening out happening with these portfolio managers, and you can see that by low volatility contraction patterns where the stocks are trading. They had a correction and they're trading very tight, that have better valuation in those same sectors. An example would be Cisco in the technology area. Another example would be Cerner in the healthcare sector, where managers are just saying, look, I'm going to just peel some off of Adobe. I'm going to peel some off of Microsoft, and I'm going to do a net add to Cisco. You know, and that, I think that's what's going on right there. They're not making those moves because they go, wow, Cisco is a great company that's going to just be on fire. No, they're doing that because it's like, well, relative value here. So whenever there's stability in the market, then relative value becomes the game. But whenever there's scarcity and growth, then it becomes looking for where is that growth and focusing into that. So as we have this move, and I know you know all this stuff, I'm just kind of expounding upon it, but I think that's what we're seeing here. It's not because Cerner's an amazing business. There's a ton of risk around Cerner's business. Yes, it's a better value. Yes, they have a strong balance sheet, but they're not likely to grow real fast, right? Probably not as fast as Adobe. But
no, it was an acquisition. Yeah, it was a roll-up.
I might as well put some money there. If things are stable and I don't lose money because of the value being broken down, then I might as well put some money there because maybe I'll outperform. And if you look at in the energy sector, energy is still having a tough time. If you look at since the March 20 low, energy has had a very tough time outperforming the market. There's very few that have, CVX would be one, very few companies that are outperforming since the low. Because that's one of the things that technicians like to do is say, since that reset happened, where has the net money been flowing into it? We've seen an acceleration in basic materials. That whole sector has moved higher. And a lot of it has been driven by gold and special chemical.
Yeah, like an example, like financials are not moving. I mean, again, they've been left behind. So that tells us something, right? Because financial should be a leading sector, and certainly now there's no action there. So
the only action that's happening in the financials is niche companies that have something that is really useful right now.
Yeah, we just sold Market Access, which we love. Could not love the business anymore. They are disrupting the bond trading business. They are gaining market share, everything. But when you look at the valuation, the thing sells at 34 times revenue or 100 times EBITDA. And you're like, that's fine. It's growing fast and they're small. There's plenty of market share to be had. But you want to reverse engineer. We've seen that over and over, like what is priced into the market, how much growth. It's basically priced as maybe bigger than the market that it's in. And that's how you know, okay, maybe we don't have a valuation case to own that stock. We've seen that with Taser, right? I mean, just names in the past, if you're old enough, you remember like Tasers. It was priced at one point where I think every woman, men, and children in America would have one or two Tasers. That was basically what was baked into the case.
I don't think it's at that valuation, but I get it.
Yeah, exactly. But I think we saw the same thing with the GoPro cameras, where the number of GoPro cameras were larger than the addressable market. So we always have to keep ourselves in check with that. I know I'm going more company specific, but so like you said, the one hot shining spot in finance, the financial area, people just flocked to it and made the valuations, unsustainable.
Anything fintech and
exactly.
And that's just trying to make financial services more efficient. Yeah, and it's just the amount of change that's happening right now is so dramatic. My mother, who's is quite a bit older than me, not that she basically is saying, I've never seen anything like this before. I mean, like I lived through the '60s, and there's nothing like this in the '60s. And I thought of that because I was listening to a podcast where this interviewee said that, and I agreed. I was like, my mom was just telling me that exact same thing on the phone. And she, like she thinks this is crazy, like comparative to what she saw. And as you know, I lived in the South Side of Chicago. We saw some stuff, and it's pretty crazy what's going on, and it's happening all over the world. What's cool is we have a lot of capital, and that capital can create new innovation. And I think that will always be a theme, that independent thing. And some of these bigger, more traditional companies will likely become back into play. Like your typical portfolio manager construction stuff will come back into play. But when you have the interest rate environment change, I think it's going to be a little bit different there. We'll see how that pans out. But we don't own any international bonds right now. I think we might need to.
Agreed.
So, it's very hard to figure the currency part out. You can buy companies that are, unless you're trading commodities, unless you're trading futures. But if you're not, then I mean, you could be looking at companies that benefit from a lower dollar, or you could be looking for fixed income securities that are denominated in stronger currencies, or you could look at commodities. And so we'll see what happens with that. The commodity cycle has been under pressure for quite some time, And it's just now kind of starting to stabilize. It hasn't even begun to act. I mean, this is not, there are some technical analysts that are very respected that believe that gold is actually topping right now. I disagree with them, but that thought is out there. You know, very well respected analysts are thinking that it's topping. So, but anyway, we've gone over a ton of stuff, riffing.
Yes.
I like to hear your riffs. So I guess that's it for now. Do you have anything else you want to talk about? Or are we?
No, I mean, again, just trying to keep you guys, you know, whoever wants to listen to this, current on what we're thinking. And right now, I think there's a lot going on, and we're fully trying to stay ahead of it and position ourselves for that next wave. So interesting themes going on, developing in the market right now, which is exciting. And yeah, just you know, keeping doing what we're doing. So
Excellent. All right, man. Well, thanks a lot. Enjoy the rest of your day, and I will talk to you soon.
thanks for the chat.